Good afternoon and welcome to Hermitage Wealth Management's Q1 2025 market overview. Excited to have a couple of guests with me from First Trust. They're going to introduce themselves and then we'll get started into the program.
Hi, I'm MJ. I'm helping out Mitch. Before we dive in, I would like to introduce our presenter, Andrew Opdyke. Andrew is our Senior Economist here at First Trust and a key member of our First Trust Economics team. Bloomberg has recognized him as one of the top U.S. economic forecasters in recent years. He plays a critical role in analyzing economic indicators, writing commentaries, and contributing to the First Trust Economics blog. With that, I will turn it over to Andrew.
Yeah, thank you so much for giving me the opportunity to be on here with you today. Obviously, it's been a heck of a year to start off. Here we are kind of working on closing out the first quarter of the year. Certainly a lot of things to talk about, whether we talk the economic stage, the market stage, the political stage. But Corey, anything you want to hit on before I kind of dive in and talk through what we're seeing?
Sure. I think, I'm highly anticipating this particular market review because there is so much going on. I mean, our clients are dealing with a flurry of headlines, from every direction, it seems. And so I'm hoping today we can kind of get into some of the more fact-based facets of the global and macro and economic environment, both, U.S. and abroad. Just to let you know, we've got a lot of clients on the call today, probably more in attendance than we've ever had before for a quarterly market review. And I think it has to do with just that, those headlines. So today you're speaking to a lot of our clients and friends. They could be participants in retirement plans. They could be direct wealth management clients of our firm. So yes, we're looking very, very forward to what you have to say today.
Fantastic. Well, then let's jump into it. And as you mentioned, I think data really is critical because particularly when we go through times with a lot of volatility, and we're sitting here having conversations that we've been having throughout, the last month or two about things like tariffs. And well, the idea, I think, makes sense. We're putting a tariff on. Maybe that's going to change some imports, exports. Everybody's hearing about the impact on prices. What I like to do is look at history because this isn't the first time that we've done it. In fact, here we're sitting here. It's Trump 2.0. We had Trump 1.0. And during that administration, a lot of these things were tested. Let's take a look at how much impact they had. And like I said, I want to start by talking about the tariffs. As I travel the country, I spend a lot of time reading, writing, speaking to financial advisors, small and mid-sized businesses, some Fortune 500 companies. But really, one of the most interesting groups that I've had to have conversations with early this year has been industries. I've talked with the National Society of Structural Engineers, some people at the Steel Institute, the Copper Institute. These are individuals and groups that are at the core of a lot of these discussions. You hear tariffs on steel and aluminum. The talking heads on TV will tell you what they think. I wanted to know, what are the businesses feeling? How are they considering this as they're planning here for 2025 and out into the future? And they said, hey, Andrew, there's a couple things that we're looking at. First off, we go back to Trump 1.0. When, by the way, we had steel and aluminum tariffs. And they said, when you go back and look at the first term tariffs that went into place, and those were primarily going in on China. China, again, is one of those groups that's seeing escalating trade tensions. There's been this misunderstanding between the United States and China going back, 10, 20, 30 years. China, it appears, misunderstood the word copyright. They thought it meant the right to copy. I'm sure it was just a translation issue. But the tariffs have been used by both sides, Democrats and Republicans, in terms of trying to address some of those issues. What did we see during the first administration when tariffs got put in? Well, it's interesting. When the tariffs got put in place, we did not see a decline in U.S. total trade. We did not buy less from abroad. We didn't sell less from abroad to abroad when the tariffs went into effect. What it did is it moved where activity took place. You saw activity that was taking place in China, and that created uncertainty. So companies had to decide, are we going to live through this uncertainty? Would we rather be somewhere else where maybe uncertainty is diminished? And they started to move their plants from China to Vietnam. They started moving them to Taiwan. They started moving them to Malaysia. Some of that went to Mexico. Some of that went to Canada, and even in places in the EU. So we saw a shift. We didn't see a reduction in activity. We saw a shift towards what I would call more reliable trade partners. Now, this time around, we've seen initial discussions on a handful of countries, starting at the beginning of April. President Trump has said he's going to do reciprocal tariffs, which is going to be more broad-based. It's going to hit across the board. And here's essentially the idea behind that. Here's the United States, and we're looking at the U.S. and our 10 largest trading partners. Now, our 10 largest trading partners, you'll notice, if you can see the chart, that they all have higher tariff rates than does the United States. And this has been kind of a point of discussion, a point of contention at times. The U.S. went to places like the EU and said, hey, EU, if we ship a car to you, you charge us a 10% tariff. Okay. You ship a car to us, we charge 2.5. So let's do one of two things. Either we can come up to you, we can raise our tariff rates, we'll charge the same 10% that you charge us, or you can come down to the 2.5 and we won't change the tariff rates on you, but you ease the trade barriers on us. Let's make this a two-way street. We have tremendously deep trade relationships. Canada and Mexico are really right now our number 1 and number 2 trade partners. China, which was number 1, has moved to number 3. That's one of the only countries that we've actually seen a net reduction in activity with here over the last 5, 10, 15 years. What I would expect to see on the tariff front as we progress through this year is some of these tariff rates over here moving towards the US. I do believe that at the end of the day, well, there may be some disruptions along the way and it creates the uncertainty, which creates a bit of heartburn. At the end of the day, I think we will move towards freer trade, which I think is a net benefit. Now, a lot of questions have come up during this process. And one of the biggest questions is, during this transition process, isn't it going to be inflationary? We just went through a period of inflation. We went through this difficult time period following COVID, where the Federal Reserve, if you remember, told us, don't worry, inflation's not going to show up. But it didn't just show up. It showed up at the highest rates we'd seen really since the 1970s. We raised interest rates. It became more expensive to borrow and buy a house, borrow and buy a car. With those rates now on the way down, is this a risk that the Fed's going to have to hold off on movements? Is this a risk that inflation is going to reaccelerate? And I'll tell you, I believe the answer to that is no. I don't think that tariffs are that inflationary. Now, in order to understand that, I want to walk you through an example that we created that tries to simplify the idea of inflation. So here's
and Andrew,
I think. Yeah, go ahead.
It's such a good point. And before we do that, I mean, this is exactly, I think, with so much uncertainty out there, the types of facts that people need to be hearing right now. When you look at the slide on the screen right now, the U.S. essentially has, on average, a 3.4% tariff, right?
Yep.
Across the board. So we don't charge as much to sell our products in other countries as other countries charge us to buy their products.
Mm-hmm.
Essentially, because of the world, if you look at the U.S. economy and we have such a large percentage of overall GDP, why do we do that? Why did this happen? How did this happen? It's essentially we're being taxed to buy these goods and we're kind of subsidizing the rest of the world. Why?
Yeah. I mean, to a degree, it's one of the downfalls of being the global leaders is that when we go through, let's say, wars, right? World War I, World War II, Vietnam War, Korean War, we tend to be one of the countries that leads in terms of helping other countries rebuild afterwards. We tend to be the country that says, hey, if we're going to try to broker a peace agreements between Russia and Ukraine or between other European countries, areas in Asia, we kind of step in and we've given other countries some advantages to say, hey, we know this is going to be difficult for you. How can we all come to an agreement? And what that's ultimately done over time is places said, hey, US, you're a major buyer. We know that you have some of the strongest consumer base. We also know, I mean, consider this. The US has 4% of the world's population and produces 25% of the world's output. We are, hands down, the most productive nation on the face of this earth. And so as countries are catching up, historically, less developed countries are allowed to have some higher tariffs as they're developing. That was China's argument 10, 20, 30 years ago. But as other countries have caught up, they've said, hey, we like protecting our local industries. We get votes, we get political support from certain industry groups that don't have to face as much challenge from outside. So they've left up more barriers than the United States. And now we're reaching a point where the US says, hey, let's all play by the same rules, which I think is a fair way of doing it. It disrupts the apple cart. Other countries don't love the fact that we're saying, hey, you've had this advantage. Let's even the scales a little bit. But, it's one of those things that if you don't do anything about it, it just keeps going on in this unbalanced fashion forever.
Terrific. A great way to, absolutely. Yep.
Yeah.
Very good. All right. So the concern, yeah, and I think the concern there is, okay, well, is this going to create inflation, right?
Yeah. So I want to walk you through an example, and this is how I think about it. This is a way I've used to describe this to a number of people over time. And in order to understand inflation, I want you to imagine we lived in an imaginary world that only has two things, okay? Only two things that exist here are $10 and 10 apples. Okay, that's it. So with $10 chasing 10 apples, you can run the math in your head. You said, okay, if the dollars chase the apples, people use the money they have to buy the goods available, and Apple's going to sell for $1. That's our starting point. Okay.
Yeah.
And now what we need to think about is how the economy evolves, whether that's through tariffs, whether that's COVID. I'll tell you, the Federal Reserve really missed the boat when we were going through things on COVID. They said, hey, you know, the world is changing around us. And as we went into 2020, the back half of that year into 2021, we saw massive money enter the system, 30 to 40% more cash in the hands of consumers and businesses. That was PPP loans, direct stimulus checks, additional unemployment benefits, right? As that money hit the system, the Fed said, don't worry about it, right? Don't worry about it. That's not the issue. The issue is going to be the supply chains. And you probably remember hearing about this as we were coming back from COVID and we weren't taking the flights, we weren't at the sporting events, we weren't at restaurants. We went through that time period where we wanted the world to come to us. We had that 2-week time period where Peloton was the greatest company on earth until it wasn't. We had a time period where Zoom was worth more than Exxon. And if you turn on the TV, you probably heard about the Port of Long Beach that had 111 ships waiting offshore, waiting to dock and unload. And the Fed kept pointing to that. Washington kept pointing to that, saying your supply chains are the inflation problem. Get all the production back and everything's good. And I sat there and I thought, wait a second. If we've got $13 in the system, let's assume we never lost any production. Let's assume that none of the apples got caught up in shipping delays. Let's assume that nobody was working from home or couldn't work, and therefore we weren't producing all the apples. If we never lost a single unit of production and the supply chains kept humming at the same pace that they were before, if you've got $13 now and you're still producing at full capacity, well, $13 to 10 apples is going to push up the price of an apple. And the Fed said, well, okay, yeah, but think about this, right? We are not producing 10 apples and we've got the money. So $13 chasing 5 apples, that's $2.60 per apple. If you get the other apples back, right, then in that type of environment, this price is going to come down. And what they didn't communicate well, what they didn't explain well, is that we weren't going to go from here back to here. It's not that prices were going to go back to their 2019 levels. It's that they wouldn't stay necessarily at the high level they would if we never fixed the supply chain, but we were going to have to deal with the money in the system. And that was kind of this complexity, this difficulty. They didn't do a good job predicting it. They also didn't do a good job of forecast. They told us back in the early 2021, they said, hey, look, inflation's going to end 2021 at 1.7%. We ended up by the end of 2021 closer to 7.0%. And they kind of looked at that and said, okay, yeah, give us a little credit because we got one of the numbers right. We knew there'd be a 7 in there somewhere. Just had it on the wrong side. But that's when they said it was time to raise interest rates. Now, I think that helps to understand where inflation comes from. It can come from apples going down. It can come from dollars going up. So let's use this real quick and think about what it looks like on tariffs. If we have a tariff, and let's say, let's call this first apple, let's call that a car. And you could say whether it's steel and aluminum or whether that's, you know, tariffs that we've got on Canada or Mexico, whatever the reason behind it, I'm going to tell you that this apple now costs 15% more. Right. And Ford Motors comes out and all these other companies come out and say, look, there's your inflation. This apple costs more. Therefore, you have inflation. But let me ask you this question. If the car costs 15% more and you have to buy it, you can't just repair your existing car. You can't hold on to that any longer. That's what people really do. But let's say you had to buy this car. Let me ask you this, Corey, did your income go up 15% because tariffs are in place?
No, I think what you're saying here is if the money supply chain doesn't change, why should tariffs change inflation?
Exactly. And but it's one of those things where people see the item and they don't think about the other apples. If the money doesn't go up by 15%, if that stays at the same level, what you've seen historically, and we can see this in multiple past cycles, is that maybe you eat out a little bit less. Maybe people don't go on as many vacations. We make trade-offs. And this happens when oil prices go up and down. This happens when we have egg prices go up or down. People make choices. Now, that doesn't mean it feels good when tariffs go in place. It might not be inflationary as an economy. It doesn't feel good when you have to spend money on one category and you don't have as much for leisure and hospitality. You don't have as much for the things you want to do. But we need to differentiate what feels good and what doesn't feel good and what's actually inflationary. And that's something I think is being misunderstood in the economy today.
Absolutely.
Yeah.
So your point, I think, Andrew, there is if you have to buy that car, you have to go without something else. So there's no change in dollars in the system. Some goods will cost more. You'll have to make choices about other goods. But all in all, that's no cause for inflation. Tariffs aren't an inflationary issue, like fundamentally.
In and of themselves. They'll cause inflation in a category. They'll cause inflation in a product. But economy-wide, you don't tend to see a notable economic impact that comes from tariffs.
Interesting. Very good.
Yep. Now, that's going to be a challenge for the Fed, right? And the Fed, it's an interesting conundrum because the Fed started last year cutting interest rates. They said, we think we're seeing enough progress on inflation. And this is one of the things that's begged the question going into this year. They started cutting. They cut by 0.5%. Then they did 2 more cuts of 0.25%. So a 1% cut in interest rates during the end of last year. And now they're talking about pausing. And people have asked really 2 questions. One, if inflation has been a concern, because inflation numbers, what's being reported, and there's a number of different metrics they use for that, inflation's been basically sideways since the Fed started doing their cuts. And some people have asked, well, why did you keep cutting if inflation was still too high and not coming down? And now people are asking here in 2025, what is the path for them moving forward? So let me take a minute. I was thinking, let's walk through why they started cutting if inflation was still elevated. What is the concern? Because this is something I think you're going to hear about as we move into the later parts of this year. And it's a category that, quite frankly, gets a lot of attention. It's the jobs. Right. And the Fed has 2 mandates. That's what they're called, a dual mandate. They're supposed to talk about inflation and employment. And they're supposed to try to keep inflation 2-ish% or below. And on the employment side, try to keep a comfortable level of unemployment. We're never going to have 0% unemployment. And quite frankly, wouldn't be a good economy if there was no one available to do any new jobs. So what they look at is 4% unemployment, 5%. That's a historical average. Now, this is where we continue to see some strange things happening in the economic world, the data world, that unless you take the time to dig beneath the surface, what you see and what you hear and what's taking place can be different things. The chart that's up right now is looking at jobs, right? And it's looking at job growth in the United States, how many people we've had working over the last 20, 25 years. And there's a couple things on this chart that stick out, right? We all remember March and April of 2020. Remember how crazy March and April in 2020 were, where we weren't sure if we were allowed to go to the grocery store. We weren't sure if Starbucks was going to be open, but we all survived the great toilet paper run of 2020, right? Really strange times. During that time period, we lost more than twice as many jobs as we did during the entirety of the financial crisis. But now you look at the back half of this, and we went through that recovery, and we got back to where we were before, and now job gains are kind of running at the same pace that they were in the pre-COVID time period. So what's wrong with this picture? Why should the Fed be concerned about jobs? The main reason is because what's driving jobs here is very different from what's driving jobs during prior cycles. In fact, during the entirety of the last cycle, there are 2 sectors today that are dominating job gains. And I crisscross the country and I ask people, what 2 sectors are they? And I get a lot of people who say maybe it's technology because I've heard so much about AI. I hear people talk about leisure and hospitality because people have been traveling and getting back to restaurants. I hear people saying maybe it's construction. But the reality is the 2 sectors that have dominated employment gains are government, number 1, and healthcare, number 2. Now, government, my wife's a school teacher, right? I don't have anything against government workers, but from a economic growth standpoint, from a market performance, equity market performance standpoint, government is not historically a large driver of performance. This tends to be more regulatory oversight. And the more, think about it this way, when the government is spending, when they're paying for a project, they're paying to build a bridge, they're starting a new venture, the dollars that get spent, government doesn't create money. They have to get that money from taxing or borrowing. So it's got to come from the private sector to fund the public sector. And the bigger the public sector grows, it can create difficulties for private sector growth. Now, these 2 sectors, if we go back to the last recovery, the recovery from the financial crisis, they were 12 to 25% of job gains during that cycle, depending on the months, and it goes up and down. Now they're running at 60% plus. And
Wow.
we had this stretch in here. You see the stretch that we had in 23 into a lot of last year. I mean, we had 12 to 18 months where there was not a single month that the entire rest of the economy added jobs at a faster pace than just the government and healthcare sectors. And you can even see months in there where the private sector, these small and mid-sized companies, were in fact down. And so this is what triggered an alert for the Fed. This is one of those things crises are very difficult things to deal with. I don't envy the position of the president. I don't envy the position of the people that are working in Washington. Whenever we have a big downturn, a recession, a crisis, the gut instinct is let's do something about it. Let's try to stimulate, let's try to grow it. But sometimes that creates unintended consequences afterwards. And now the Fed is kind of tasked with balancing. We want more of the jobs to be coming from the all else. That's more sustainable. We want to see more of the gains coming from these private sectors, which helps to fund the government side of the equation. And when those pieces get out of balance, the Fed started to look last year and said, maybe we need to start looking at how we can support, how we can get growth looking more like this and less like this. Well, how do you do that? One of the ways to do that, small and mid-sized businesses, mom and pop shops in particular, they're sensitive to interest rates. Their ability to borrow and their cost of borrowing to invest in their staff, their inventory, their building, that has become a critical discussion. So at the end of last year, that was really what they were focused on. Can we now focus on some of the employment concerns we've got? Can we get rid of, put us in an environment where we're not seeing declines on the private sector? That's where they wanted to be coming into this year. But now they have to deal and balance that with the inflation concerns, which is a whole nother category where things aren't moving as they should be. But, Corey, I think this is something you're going to hear about a lot as we move through this year, particularly if through the uncertainty companies hesitate with hiring. The jobs front is going to become a major conversation, and the Fed's going to be making a decision. What are they going to prioritize? Is it people or is it prices?
Yeah, I think too, when you look at your chart, I mean, one of the questions I think we need to consider as well is, was there over hiring coming out of COVID, 2022, 2023, and then it all sort of dried up and went away in the private sector. So it'll be interesting to see, but that's your call on why the Fed decreased rates. We've had those 1 point decrease since Q4 of last year.
Yep.
Interesting.
Yeah. And that's and Jerome Powell, the chairman of the Fed, basically came out and said, he said, we have to balance these two concerns. And as inflation pressure started to moderate, this started to rise as a concern from our front. Now, he's not out there screaming from the rooftops, hey, this is a terrible employment market, but he said this is something we need to watch. And as you mentioned, right, we have seen some of that private sector employment dry up. And that again is another interesting one, because think about how that economy changed. Think about where the jobs went. Okay. I'll argue this is one of the reasons we have the inflationary pressure. Go back again to 2020. Let's go back to the back half of that year. Let's go back to the Peloton time period. Let's go back to the work from home, right? When all the industry activity shifted to goods and it shifted towards companies that were bringing the world to us, that we started moving workers too. We said, well, if you can't be in the restaurant, if you can't be serving, if you can't be cooking, or if you can't be, working at the arenas, the movie theaters, whatever it may be, let's go ahead and start trying to get workers moved down here to the good side of the economy. But what's happened on the good side? This one is, it's kind of wild. If you've ever taken an economics class, or if you ever open an economics textbook, I'll tell you that what's happened over the last 2-3 years is the polar opposite of what that book will tell you should happen. After we move those workers down, after we brought them to the good sector, you can see on the chart, yeah, this was that period where maybe they overhired. What's happened since? You can see that the data here, the people, the consumers, have gotten back to services. We've gone out on more trips. We've gone back out with friends to go to the restaurants. We are engaging with the economy, but the goods got a little ahead of themselves. Now, I want you to do something for a minute. I want you to assume for the next 2-3 minutes that you are the owner of a manufacturing company, and you can pick your industry, your sector, what you produce. But I'm going to tell you, you manage, you're the CEO of a manufacturing company, and I am going to be a group called the Institute for Supply Chain Management. Okay. What I do is I come to you every month and I say, I want to gauge how well you're doing. Not just you as a company, but the sector, the industry. I want to know how manufacturing in the United States is doing. So I'm going to ask you a handful of questions. Every month I'm going to come and say, Corey, hey, are your orders up or down? Is your production up or down? Are your order backlogs, how many orders you have that you haven't been able to process yet, are those up or down? How about your employment, up or down in prices? Are your prices up or down? Okay. So they're relatively basic questions. I don't need you to give me an exact, oh, orders are up 25. All I need to know is, are they up or down? I just want to get a general gauge. So here's what I'm going to tell you. I've been asking you this question, everybody else in the sector, the industry, that question. And for 23 of the last 25 months, the industry as a whole has said, well, our orders are down, production is down, we've worked through order backlogs, we are not hiring, but we're not firing, and we are having still some issues with prices. So here's what I want to ask you, Corey. If that's you, if you're in this environment where your orders have been down, production's been down, supply chains, still having some issues for 23 of the last 25 months, are you today saying that, A, this seems like a great time to build a new factory? This is a great time to go ahead and put out a new product line to try to increase production. Or B, are you saying, wow, this is tough. Maybe we did overhire. Maybe we did get a little over our skis, but now, let's huddle back up. Let's tighten things up. Let's get through this time period. Activity will come back eventually, and when it does return, we'll get back with it. If that was you, Corey, which side would you be on?
I'd be in the latter half, no question.
Your CFO would certainly hope that was the case. And now what we have to do is reconcile that with this. Okay, the data now on the screen over that same time period. The same time period where these companies on the manufacturing side have said our orders are down, our production's down, our order backlogs are down. We've seen a tripling in manufacturing construction spend. The exact polar opposite of what the economics textbooks say should be happening. Now, let's remind ourselves real quick. Where were interest rates going into 2022? They were pretty close to zero, right?
Mm-hmm.
We had that time period where the 10-year treasury was paying about 1/2%. What's happened here over the last 2-3 years? Where have interest rates gone? Higher or lower? They've gone up. Now, when it becomes more expensive to borrow and buy a house, do people tend to buy more homes or less?
Less.
They tend to buy less. How about when it becomes more expensive to borrow and buy a car? Do people buy more cars or less?
Less.
They buy less. Companies, would you expect that when it's more expensive to borrow and build a factory, particularly during a time period where you don't have orders, would you expect that interest rates moving higher would cause them to invest more or less? The answer would be less. So what's going on? And, one of the conversations that really made it clear to me why this was happening, I was talking with a recently retired Fortune 500 CEO, and he said, Andrew, we had these government actions that came out. We had the Inflation Reduction Act, we had the CHIPS Act, and we were getting funding. The government was coming out and saying, well, we'll give grants. We want to bring some supply chains back to the United States. We want U.S. production. We'll pay for 20 to 40% of your project. We'll subsidize the loans to make sure that the costs are reasonable. We understand you might not have the work to do today, but these facilities, they're not going to be done for 3, 4, 5 years anyways. By that point, hopefully activity is returned. And I looked at that and I said, well, I don't blame you. If you're the CEO of a company and all of a sudden the government says, we'll pay for 40% of your project, you can either say, hey, I'm good right now. We don't have the activity. I'm going to wait. Maybe we'll build this facility in 2 years. Or you look at that and say, if I wait 2 years and wait till the activity's here, they're not going to pay for 40%. How often do I get a chance to build a factory at half the expected cost because I'm getting this subsidized and I have a guaranteed lower rate? A lot of these companies took that and said, hey, why would I say no to free money? Why would I say no to a cheaper cheaper cost to build? Activity will return. Now, what this has done is the people that we moved, right? All those workers that we moved from the service side to the goods side, these companies have said, we're building a factory. It's going to be done in a year and a half. We're not going to let our workers go right now and try to rehire them when this factory is done. They've held the workers despite the fact that their orders and production have been down. So what we've done, right, is the inflation, which has been moving sideways here of late, but is down off its highs. We've seen a transition in the economy from goods, where that supply chain definitely was an early issue, but now we've seen the issue switch to the service side because we moved the workers away from them and we've put incentives in place for the natural transitions in the market to not functions in the way that they normally did. It's kind of, again, it's complicated to the degree that unless you dive into the details, it's hard to see what's taking place. But as soon as you start peeling back the layers, as soon as you dive into the data, you help to get a better understanding of the complexity that the Fed is facing today.
Yeah, I don't envy Fed chair. I can tell you that.
Yeah. Yeah.
Yeah.
So, this kind of brings us to a point, and this is an area where people are looking at 2025 and say the Fed doesn't have an easy job. And, maybe we're going to have some uncertainty here because of the tariffs. Back half later in this year, we're going to have we're going to have the extension of the Trump era tax cuts. There's a possibility that the corporate tax rate could be brought lower. There's probably going to be some deregulation. There's some things in the back half of this year that are going to be very business friendly. In the short term, immediate term, the uncertainty is causing the markets to say, hey, let's just make sure that we've got, our heads on straight related to how much we're valuing these companies at. Let's try to figure out and price in a little bit of this uncertainty. Plus, there's the geopolitical, which does impact things, right? Freight rates have been a great example. When we've had conflicts in Israel and Gaza, we've seen escalated freight rates. And now, there's a question of whether that ceasefire is going to end. There are outsized factors that could make the inflation picture a little cloudy as we progress through the remainder of this year. The Fed still has work to do. But I always go through this, and as we come towards the end and we start thinking about where do we go from here? What does the rest of 25 look like, 26, 27, 28? As I think about economic growth, it comes in waves, but there's certain factors that impact it more over time. And, think back over the last, think back 25 years. It's kind of wild to think that we're sitting here 25 years ago is Y2K, right? We all remember, I think, where we were on Y2K when we weren't sure if the lights were going to go out. We weren't sure if that VCR was going to start blinking midnight and that tape from Blockbuster wasn't going to work. Think about how far we've come in the last 25 years. And then ask yourself, how much of that progress over the last 25 years came because the Fed cut in a July versus an August?
Mm-hmm.
Pretty much nothing, right? Realistically, how much of the progress that we've seen in terms of technological achievement, the explosion of the internet, smartphones. I mean, we take it for granted that we walk around now with these devices in our pockets that give us greater access to information than the president of the United States had 25 years ago, right? How much of that does Apple choose to build another iPhone because of who got elected in any given year? I would say the answer is no. Did Amazon come into existence because of who the president or a senator was during that period of time? The answer is no. It's what happens outside of Washington that really moves us forward over time. It's the entrepreneurship, it's the private property rights, it's the rule of law, functioning democracy that is so unique and incredible in the United States. And when I start thinking about where are the big picture things moving, I look at charts like this. Okay, the chart right now, it's global adult literacy going back over the last, basically 200 years. And I'd love to tell you, I just found this chart on my own. It actually, the person who brought it to me was my wife's grandfather, and he turned 100 years old in October. Grandpa Dahl, Cliff Dahl, an absolutely incredible guy, grew up in the Great Depression. He fought in World War II. He fought in the Korean War. His kids fought in the Vietnam War. He went through the inflation of the 70s, went through race riots, watched the Berlin Wall fall. He watched the opening up of China. He went through market crashes in the 80s. He went through the dot-com bubble, 9/11, the financial crisis, went through COVID. And I'm like, Grandpa Dahl, like, how are you dealing with all this? And he said, Andrew, the best advice I can give anyone for my 100 years on Earth is turn off the TV. And I said, wow, that is very good advice. He's like, it's all doom and gloom. He said, as somebody who's been alive for 100 years, I will tell you that I could have never imagined when I was your age. Now, he was my age. I'm about 40 years old, right? When he was turning 40 years old, that was the 1960s. Here's what's amazing is that when he was turning 40 years old, notice what happens on this chart. When he turned 40 years old, it was the first time ever in human history, ever in the history of this planet, that more than half of the world's adult population was literate. And he's like, when I was 40, I could not imagine what the world my kids, my grandkids, and now my great grandkids would grow up in. He's like, you can't imagine how different things are. And that perspective of how far we've come, if you truly stop and appreciate it, he said, look at this chart and look at this chart. Is there any, I mean, you think it's a coincidence that as people have had the capacity to learn, to understand, to grow from those who came before them, that we've seen this massive, massive reduction in the percentage of the world living in extreme poverty?
Wow. Yeah.
It's amazing. But now the last thing I want to do is I want to dive in on this last 20 years. I want people to understand the magnitude of what's happening. Right. This is the World Bank. The World Bank puts out the data and they said, hey, we define extreme poverty as the people living on $1.90 per day, inflation adjusted. You go back to 2003, that's 1.6 billion people on this planet living in extreme poverty. Last full year we have, which is 2023, you're looking at 714 million people, which granted is 714 million too many. But now let me run a couple numbers for you. That means over that 20-year time period, we saw over 900 million people move out of extreme poverty. That is an unbelievable number. Now let's take the number of days, right? We can note, by the way, that if we kept at that pace, that in the next 20 years we could eradicate extreme poverty. But we did that in 7,305 days, which means we averaged over this 20-year period, over 20 years, close to 125,000 people per day moving out of extreme poverty. I mean, that is a shocking number. It's an incredible number. I'm based in Wheaton, Illinois, about 26 miles straight west of Chicago, a pretty good sized city here in Illinois. That's twice our population every single day. And, it makes me think, as an economist, it makes me think that as we move in this direction, right? People have talked about U.S. immigration problems. You know who doesn't have an immigration problem? Cuba. You know who doesn't have an immigration problem? China, Russia. There's a reason that people want to be here. There's a striving around the globe as people are progressing, as they're moving out of poverty. They want more of what the U.S. has. We've again 4% of the world's population producing 25% of the world's output. We've become a beacon of what is possible, and people want to embrace that. They want a piece of that. As we go through here, the next few months, let's never lose sight of what's happening as the world moves out of poverty and their capacity to purchase grows, as their capacity to produce grows, as human potential is unleashed at a scale that we've never seen before. They are going to want to increasingly interact with the U.S., engage with the U.S., try to build and use the tools. We are the world leaders in technology. We have the best financial system in the world. They're going to want a major piece of what we've got. I think you're going to see, if we get, some of these tariff rates down, we move towards freer trade. We are sitting in kind of an incredible time period to be alive. What the potential for what is to come is pretty incredible. And let's never lose sight of that as we go through the short-term turbulence that we've always had, we always will have, and yet we progress through that each and every day.
Absolutely. Well, Andrew, this has been absolutely terrific. I think most of the folks on this call are probably attending the call today because they're dealing with a lot of uncertainty right now that they're seeing on the news. And I think even more important than what you shared about tariffs and inflation and where the Fed is in terms of rates probably not moving because of that labor picture and how it affects overall labor markets and where they need to move. I think the wisdom that your wife's grandfather imparted, after his 100 years of life, is that to maybe put the blinders on and not pay attention to all the uncertainty that you see on the news today. And so I think that message is important, and I think it holds true. So we appreciate you sharing some of this from a factual standpoint. If anybody has any questions, I'll just close with the fact that you're always welcome to give us a call here at Hermitage Wealth Management. We've got a team here that's willing, able, and happy to assist you with any of the questions that you might have. So, Andrew, thank you again. Our gratitude to First Trust for you being here today, and we'll look forward to having you again in the future.
Sounds good. Thank you so much for having me.
You bet. Bye now.